Good evening and welcome to the Economic Bulletin here on Q News. We bring you the latest top economic stories along with expert analysis on the events and trends shaping the regional and global economy. Throughout our coverage, we spotlight the key sectors, highlight the defining economic developments of the moment. And to start with the latest headlines, we'll hand it over to our colleague Rana Qassas for the top economic stories this evening. What do you have for us this evening, Rana?
Thank you so much, Riham. We have a lot and plenty news and developments from all around the world. And we start off with Europe, where National Statistics Agency, ISTAT, has reported that Italy's unemployment rate edged down to 5.0% in May, the lowest level since comparable records began in 2004. Despite the decline, the economy lost net 22,000 jobs during the month as fewer people remained in the labor force. Youth unemployment also fell to 15.1% from 16.4% in April. On a broader basis, employment remained resilient, with 119,000 more people in work than in the previous 3-month period and 228,000 more jobs than a year earlier. However, Italy's employment rate slipped slightly to 63.0%. Moving on to the United Kingdom, where the Bank of England policymaker Catherine Mann has stated that she would be prepared to support an interest rate hike if rising inflation expectations, fueled by the United States-Iran conflict, threaten the central bank's 2% inflation target. Mann said higher market interest rates have so far helped offset inflationary pressures, but she will closely monitor inflation expectations in early 2027 wage negotiations. She also noted that detailed labor market data suggests conditions are stronger than the headline 4.9% unemployment rate indicates, while warning that fiscal developments could also influence the outlook for interest rates. In Asia, the Ministry of Data and Statistics has reported that South Korea's consumer inflation accelerated to a 2.5-year high in June, cementing expectations for an interest rate hike by the central bank as early as its upcoming policy meeting on July 16. The Consumer Price Index, CPI, rose 3.2% from a year earlier, marking the biggest jump since December 2023 after accelerating from 3.1% in May. On a month-on-month basis, the index edged up 0.1%, which also aligned with market expectations. On intra-continental trade, Indian Prime Minister Narendra Modi has called for Japanese investment in India to exceed 10 trillion yen over the next decade. As he addressed the Indian-Japan Joint Economic Forum along with Japanese Prime Minister Sanae Takaichi in New Delhi. India and Japan also agreed to boost cooperation in artificial intelligence, metals, energy and defense, as well as prepare a joint roadmap for economic security as the Asian nations sought to further strengthen their ties. In her address, Takaichi noted that the international community was facing growing challenges from protectionism, economic coercion and geopolitical tensions, making it essential to strengthen regional autonomy and resilience.
Semiconductor, pharma और क्रिटिकल मिनरल्स में दुनिया को रिजिलिएंट सप्लाई चेन प्रस्तुत करें दे.
In MENA, the World Bank has approved $265 million in financing to support the construction of a new pumped hydropower storage plant in Morocco. The 300-megawatt pumped hydropower storage project will act as a giant battery for the national electricity grid, storing excess solar and wind energy and releasing it when demand rises. The project is expected to enable the integration of at least 1 gigawatt of additional renewable energy into Morocco's power network, attract around $1 billion in private investment, and create approximately 820 direct jobs annually during construction. The United States Labor Department in North America has reported that job growth slowed more than expected in June, signaling a cooling labor market and reducing expectations of a near-term interest rate hike by the Federal Reserve. Non-farm payrolls increased by 57,000 jobs, while gains for April and May were revised lower. The unemployment rate fell to 4.2%, largely because about 720,000 people left the labor force, pushing the participation rate to its lowest level in more than 5 years. Professional and business services led jobs gains, followed by social assistance and health care. Meanwhile, employment in the leisure and hospitality sector fell by 61,000 jobs, despite expectations that the FIFA World Cup would boost hiring. In Latin America, Colombia's President-elect Abelardo de la Espriella has instructed the incoming Finance Minister Gomez to travel to Washington to meet with international banks and multilateral lenders as part of efforts to refinance the country's public debt and strengthen public finance. In a post on X, de la Espriella said Colombia's debt has reached historically high levels and that refinancing it would be a key step toward restoring fiscal discipline and rebuilding investor confidence. Gomez said the fiscal deficit currently stands between 7% and 8% of GDP, while the country's fiscal watchdog warned Colombia faces an $11.55 billion funding gap to meet its 2026 fiscal target. Moving on to the energy sector, oil prices fell more than 1% to a 4-month low on Thursday as concerns over supply disruptions eased after mediator Qatar and Iran and the United States made progress in talks over ending the 4-month war that shut the key shipping through the Strait of Hormuz. Brent futures were 1.44% lower at $70.54 a barrel. U.S. West Texas Intermediate crude fell 1.34% to $67.66 a barrel. During this session, both benchmarks hit their lowest levels since before the United States-Israeli war on Iran began in late February. Gold extending its gains, climbing more than 2% on Thursday after weaker than expected U.S. non-farm payrolls data reduced expectations of Federal Reserve interest rate hikes this year. Spot gold was up 2.4% at $4,126.97 per ounce. United States gold futures inched 1.4% higher to $4,139.20. The United States dollar index was down 0.7%, making dollar priced metals cheaper for holders of other currencies. Among other metals, spot silver rose 4% to $61.53 per ounce. And those were the top economic top stories for the hour. Now we go back to my dear colleague, Vihem Mursi in our studios. Vihem.
Thank you so much, Shona, for that close look on the economics. But now for a deeper look into the economy. Despite the market volatility and geopolitical uncertainty, global deal-making is booming. Bloomberg reports M&A activity is on track for a record year fueled by mega deals, AI-driven growth and renewed corporate confidence. What's behind the surge? And can the momentum last? Let's take a closer look. Bloomberg has reported that global mergers and acquisitions are on track for a record-breaking year despite persistent market volatility. Global deal value rose nearly 30% year-on-year to $2.6 trillion in the first half of 2026, putting the market on pace to surpass the record set in 2021. Companies also announced a record 38 deals worth at least $10 billion during the same period. Bankers say firms have adapted to market uncertainty and are focusing on long-term growth, with companies continuing to pursue strategic acquisitions despite the ongoing volatility. And in global markets, they show the mixed performance across the US and Asian indices. Meanwhile, the European indices showed a broad gain. In the United States, the Dow Jones Industrial Average rose 0.47%. Meanwhile, the S&P 500 slid 0.65% and the Nasdaq lost 1.45%. Over in Europe, Germany's DAX led regional gains, soaring 2.18%, while the UK's FTSE 100 climbed 1.67%. And in France, the CAC 40 increased 1.65%. Across Asia, Hong Kong's Hang Seng advanced 0.76%, while China's Shanghai Composite sank 2.03%, while Japan's Nikkei slipped 2.47%. For further analysis, we're joined from Paris by the former advisor of the World Bank and executive director of the EU Policy Lab at the EU ASEAN Centre, Nicola Frizzetti. Thank you, sir, for joining us this evening on Q News.
My pleasure, my pleasure.
Let's start off here about asking you about the global M&A volumes. They've surged despite the elevated interest rates and geopolitical conflicts and persistent market volatility. What does this tell us about the corporate confidence?
I think it's very interesting because you're right. Interest rates are relatively high. And in many countries, especially in Europe, growth is very slow. So, Germany, France, Italy are growing at less than 1%. So typically it's not a context which is conductive of M&A, but we are seeing strong M&A activity driven essentially by the tech sector, broadly defined. So it's not only computers and AI and microchips. It's really the broad tech sector, including defense and aerospace, which has been the driving force behind that M&A activity. And a lot of that M&A activity is linked to America, to the Silicon Valley, to the US. So even when you look at Asia and Europe, a lot of the acquisitions are made either by American companies, right, mm-hmm. or by big American private equity and venture capital funds coming to Asia and Europe and buying companies.
So do you think, given what you just said there, are corporate executives assessing risk differently from how investors are assessing it in today's market?
Yes, especially that, and it's a very good question, especially because money is less tight for big corporations and big private equity funds and big venture capital funds because they're sitting on a huge pile of liquidity, mm-hmm. which is different from what we saw in the previous economic cycle. So here you have, corporates, the giants, like KKR, Carlyle, Goldman Sachs, etc. They have a lot of cash to spend, right? Mm. They have cash at the bank. And so when you are rich, when you have a lot of cash at the bank, what you can do is borrow, and you can also buy without borrowing. You have the luxury of not really needing to knock on the door of the bank and tell them, Mr. Banker, I need to borrow 2 or 3 billion from you because you have cash in your fund. And also because behind the private equity and venture capital funds, their clients are typically large pension funds from Australia, Canada, America, large sovereign wealth funds from the Middle East, Singapore, and China, and these asset owners, right, the sovereign wealth funds and the large public pension funds are also sitting on piles of cash, and we're talking trillions of dollars, and they are raising their allocation to private equity, private debt. And so they are telling the likes of KKR and Goldman Sachs, go ahead and buy more companies because we want to invest more in non-listed companies. So all that means that there's a lot of cash in the system, which is partly disconnected from short, medium-term economic fluctuation.
Mm-hmm. Well, now you're saying that these companies are sitting on big piles of cash, and we're seeing, due to that, a record number of mega deals this year. So other than the cash that's being available right now, what's driving the trend itself of these mega deals? Strategic consolidation, for instance, the race towards AI, or is it just, as you said, abundant liquidity for corporate?
So there is abundant liquidity for corporates and for private equity funds and venture capital funds, yes. Mm-hmm. And there is the belief that we are in a long, a long meta cycle driven by tech and high tech, not only AI, but also, the need for microchips, and building microchips production facilities. This is like hundreds of millions of dollars or billions for just a small microchip facility. So because, in South Korea, Holland, America, China, they're building these factories, that requires a lot of money. And the small players, typically in the microchip industry, The small players are those who do part of the value chain, right? So specialized companies in Holland, in Germany, in Taiwan, and they are being acquired, right, and merged at a very high rate, and they're being bought at very high multiples. If there's a mining sector related to tech and AI and microchip, is the rare earth mineral sector. So you also have mines in Kazakhstan, in China, in Malaysia, in Canada, in Mexico, being acquired at very high multiples. And all that is generating a big M&A activity worldwide.
Well, you mentioned the drive or the need towards, investing in AI-powered economies here, but also we've seen the rise and fall, I suppose, of trillionaires or former trillionaires like Elon Musk. Do you think that this could possibly be also a bubble when it comes to investing in the AI? Because once he became a trillionaire, he quickly dropped back into being a billionaire there.
Yeah, these are like short-term blips. So this is a subsector. So let's say now what's really hot for someone like Elon Musk is what they call space infrastructure. And so the SpaceX IPO was very emblematic of the excesses of that era. But I think it's a short-term, blip on the road. So really, that trend is broader and deeper than just Elon Musk. And there's one subsector or sector I forgot to mention linked to AI and microchips, etc. It is energy. It is the thirst for energy, and more precisely, the thirst for electricity. So we're seeing a lot of M&A activity around turbines, electric turbines, in makers, manufacturers or specialized industrial firms in Germany, in India, manufacturing bits and pieces of these gigantic electric turbines. They are also being acquired by American and Chinese and German giants. So we're seeing consolidation, acquisition at very high multiples. So all that means, I think, that the trend will keep on growing and growing unless there is a big shock to the system. So what could be a big shock? It could have been a war, like the Third Gulf War, but now it looks like it's over. So what other shock could be? It could be if there is lingering inflation, which is a possibility. So the inflation situation is a bit unclear and murky. But suppose that there is lingering inflation, in spite of the fact that the price of oil and gas is declining. Suppose the war between Ukraine and Russia gets nastier or whatever, there could be a shock to the system. So what I'm coming at is central banks in America, the Fed, in Europe, the ECB, and the Bank of England, in Japan, in Australia, if central banks, they keep on raising interest rates a little more or much more, then yes, it could burst the bubble, right?
Yes.
The only thing, in my view, which could stop the worst case scenario is really a strong rise in interest rates, which is not the consensus. So most experts believe that the central banks will not raise interest rates strongly in the coming quarters, and the consensus is that secular trend, that secular, sort of bull market will keep on going. And one more thing, fluctuation in the NASDAQ, right? It's important, but it's not what motivates the M&A, the long-term M&A activity. So what I'm coming at in the next 6 months or 5 months, we may see a consolidation, and we may even see maybe small decline in the NASDAQ and the New York Stock Exchange, but even that is not enough to stop that, sort of long-term bull market.
All right, thank you so much for your insights there. From Paris, that was a former advisor for the World Bank and Executive Director of the EU Policy Lab at the EU ASEAN Centre, Nicola Fratelli. Thank you for joining us and thank you for your insights. And now we turn to the fan favourite as all eyes remain on the World Cup for 2026. The tournament is creating winners in more ways than one. While the action unfolds on the pitch, the tournament's economic impact stretches far beyond the host countries, driving businesses, trade and consumer spending around the world. Let's take a closer look. AFP has reported that Chinese manufacturers are seeing a sharp increase in sales as demand for the 2026 FIFA World Cup merchandise surges despite China's absence from the tournament. In Yiwu, one of the world's largest wholesale markets, a licensed manufacturer said World Cup sales have increased fivefold compared to the 2022 edition, driven by demand for jerseys, accessories and collectibles, including a plush goat toy inspired by the Argentine captain Lionel Messi. The report noted that Yiwu is estimated to produce around 70% of the World Cup-related merchandise sold worldwide, underscoring China's central role in the global sports merchandise industry. The 2026 FIFA World Cup is driving a new wave of consumer spending in China as fans increasingly turn matches into social and lifestyle experiences. According to Reuters, sports bars, themed restaurants, pop-up exhibitions, and official merchandise stores are attracting large crowds, with businesses reporting growing demand throughout the tournament. Experts say more fans are planning outings and short trips around World Cup fixtures, boosting spending on hotels, transportation, dining and entertainment. They add that the tournament's economic impact now extends well beyond the 90 minutes of the pitch, providing fresh momentum for China's consumer and nighttime economy. For further analysis on this topic, we're joined from Hong Kong by the economist Benny Kwok. Thank you, sir, for joining us this evening on Q News.
Hello.
I hope you're enjoying the tournament.
Hello.
Let's start by asking you about China. It did not
Okay.
qualify to the World Cup, but the Chinese
Yep.
businesses are booming and are among the tournament's biggest economic beneficiaries. How has China positioned itself within the World Cup economy?
So hi, thanks for having me. Yes, so there's a joke in this year's World Cup from the Chinese people that even though the Chinese men's football team could not qualify for the FIFA World Cup, but they have the presence, very important presence in this year's World Cup because you are seeing many Chinese brands in the advertising boards, and also you're seeing many some of the stadiums, for example, like the Cape Verde's national stadiums are built by Chinese companies, and also many of the souvenirs are also made by the in China as well. So some of the Chinese people jokes that okay, we also the Chinese or the China also participate in the World Cup in an alternative way. Of course, we could see that it also shows the power of the Chinese manufacturing power, the power of the manufacturing around the world. That even though we are seeing the trade war between China and the United States and the possible trade war between China and the European Union, many of the industrial activities are still being controlled, at least part of them, and a very important part of them are being controlled by the China. So it is quite difficult to try to bypass China for doing things because China has a very completed, I would say, supply chain, and also for the talents, for the efficiency, for the raw materials. It could be I would say a one-stop base for producing the products, so that it could be cheap and with a quality that could export them and then supply to the buyers around the world.
Well, you're right. I mean, the Chinese may be joking that their presence is heavily felt, but it's absolutely true. I mean, Yiwu is estimated to produce around 70% of the World Cup-related merchandise sold worldwide, and that's just a city. What does this tell us about China's role when it comes to the global sports supply chain overall? And the global supply chain, it's a powerhouse, isn't it?
Yes. For example, we are seeing the Japanese and the South Korean brands slowly or even quickly withdrawing the business of making TV monitors. So the TV monitors we are seeing, for example, every day. For example, like we are watching TV every day. We are using the computers every day. The monitors now are being mostly under control by the Chinese companies because it is not it's no more, I would say, it's no more money earning business for the Japanese and Korean banks anymore. So that's why the Chinese companies, the manufacturing companies, the Chinese brands has already controlled most of the business of the TV or the computer monitors already. So it is one of the a very important example showing that China, even though under the threat of trade war from West, and China already control the some part of the very important industrial activities, even though those kind of sectors are not that really money making. But
yeah, you're right.
China control part of it. Yeah.
You're right there. I mean, even one manufacturer in China reported that there was a 5-fold increase in the World Cup sales this year compared to the 2022 tournament. How important are major sporting events for economic opportunities for manufacturers? And what does this say about the exporters if they are able, within 4 years, to increase 5-fold?
Of course, compared to the Qatar World Cup, I would say it's a little bit misleading because it was in 2022 when the world is suffering for the COVID diseases. So the base of the comparison, of course, it could be several times fold when being compared now and the year of the 2022 that was held in Qatar. And I would say that of course the Chinese manufacturers could benefit because of they could also receive the global orders of producing the World Cup related stuff and products. But I would say that in general, the manufacturers is also suffering. What I mean is suffering is that because the Chinese economy is slowing down quickly, the World Cup could only help a little for the Chinese manufacturers because the World Cup could only be held for 1 month or even more 2 months or maximum, including the pre-World Cup activities. Okay, they could be extended to 2 to 3 months only. But the global economy, the Chinese economy, is not really performing well. Especially the China consumption markets is also slowing down quickly and even suffering. The Chinese people are not really willing to spend much, and so that's why I was
Yeah, but we're seeing also due to the World Cup, even though it may be hard times before the World Cup and maybe after the World Cup, but during the World Cup, we're seeing a trend of World Cup related spending in China towards restaurants, bars, hotels, and entertainment. How has the sports economy evolved beyond the game itself, specifically in China?
Of course, if those are really rich, those at the rich have more financial status. Of course, they are more willing to spend more, not just spending into the pubs and bars in China, and they are really willing to buy the tickets to the Mexico, Canada, and United States to watch the matches. But these kinds of these kinds of people could only consist of a very limited number of the to the general China's consumption market, because those people, I would say, could standing on the 0.1 or 0.5% on the for the whole, compared to the whole China's labor market or the China's population for their earning states. So I would say in general, people are less, I would say less richer than compared to the 2022 and even the 2018. And even though, as you have said, you are quoting the states about, okay, more Chinese people are willing to spend more on watching the World Cup. But in general, compared to the general public, I would say the consumption power, I would say the choices for people, the choices involving in the World Cup, I would say is not that really involved compared to the previous years, because of the general Chinese economies does not performing well compared to the last several World Cups.
All right, thank you so much for your insights there from Hong Kong. That was the economist Benny Kwok. Thank you for your insights, and thank you for joining us here this evening. That brings us to the end of our economic bulletin for today. Thank you for watching, and stay tuned for more updates here on Q News.